Welcome back to the channel. Welcome back to a new video, everybody. And I want to thank all 2,362 of you who watched my last very touching, awesome video. One of my favorite videos that I've made in a long time that got like no views. But those couple thousand of you that watched it, God bless you and thanks for watching it. And those of you who have not, or YouTube punished me for some weird thing I must have done in my past and did not send you that video or put in your recommended or ping you when I uploaded, go check it out. It's the one that says shocked across the top, and I was able to take a really cool 75-year-old dude, cancer survivor, on a drive in the Lamborghini and surprise him for his birthday. I enjoyed it so much, and I definitely got a little personal there. So if you want to go just have a moment of happiness, see something good in the world rather than stuff I'm going to share with you now, then go do that. Go watch it. And for those of you that talk about, all you put up here is negative content about dealers and all, it's like, here's some positive content and you didn't watch it, so you wonder why. Anyways, I'm sorry for ranting. Let's talk about banks and financing and what's going to happen at the dealership to you moving forward. And it's nothing new, but it's certainly ratcheting up a couple notches. And the notches are where the dealers are going to absolutely, ooh, that's not good, absolutely try to hit you with higher interest rates. And they're definitely going to try to collect that spread, meaning that whatever rate you qualified for is likely to be higher than what you would have qualified for before, despite you having a really good credit score, a great credit score, as a matter of fact, because at this stage, the banks are getting soaked. I read yesterday that we are approaching, I think it's a 13-year run. This is the worst delinquencies on credit cards and auto loans in the last 13 years. 13 years. So for 13 years, things were pretty good. Now, things are not good. And that means people are defaulting on their car loans, defaulting on their credit cards, and it is starting to get really, really ugly out there.
We have the strongest economy in the world. Let me say it again, in the world.
Although GDP last week was far short of expectations.
And I think it's going to get worse for the banks long before it gets better. And I think you all would agree, because as long as they continue to hold interest rates high, and as long as used car values continue to drop, that means that everybody, myself included, are sitting in their Scat Pack or their RT or their Hellcat that they probably paid way too much for. I paid MSRP and I paid too much, and they can't get that money out of their cars at this point. So for that reason, you've got people with massive negative equity. And when I talk about massive negative equity, just in the last week, I've gotten multiple messages from people asking me to help them figure out how to get out of their cars, get out from underneath their car loans. And I don't have a lot of answers. You know, one gentleman said, look, hey, I want to get out of my car because I'm upside down on it. I can't afford the payment. My income has dropped. Put you guys back on the dash. My income has dropped and my car value has dropped and I can't afford this car anymore. And now I'm approaching 2 months behind, and I'm going to go and apply for a signature loan at my credit union to go just buy some junker. But the hard thing that I had to share with them is, listen, if you got behind on your car payments, then they're probably reported at this point to your credit bureaus, and you're not going to qualify for anything else. So you've got to get back on the phone and talk to your lender and try to come up with a restructuring of the loan, a loan modification, maybe a freeze on your payments, a skip on some payments, and you got to start focusing on getting more revenue into your household. And that may mean a second job, may mean you're doing Ubers and a Hellcat. I don't know, but you got to solve the income problem, because the expense problem probably isn't going to get solved anytime soon. But that leads me back to talking about the dealerships. So what's happening at the dealerships now? Well, when you apply for a car loan, especially at a lot of these dealerships, through a lot of the banks these dealerships use, what you'll find, and I just saw this on TK's channel where he put an actual rejection, a decline on his channel, on his video recently, that showed that the reason the bank declined the loan wasn't because of his credit. He had, I think it was a 780 plus FICO score. Wasn't because of his income, wasn't because of his job, wasn't because of his debt to income ratios. It was 100% because the lack of equity. I'll put up on the screen what they called it, the lack of equity in the car, meaning the price they were selling the car for was a Hornet, was not what the bank felt the car was worth, meaning they wanted a much higher down payment to be able to bridge that gap, and here's what it's called: mitigate their risk. Mitigate their risk, so that when they do the loan on that car, if this person who's taking this higher than normal interest rate because of interest rates, not because of his credit score, is going to be paying a payment on this car, if they were to default, despite having great credit, how bad would the bank get soaked? Well, it's not just people not paying that can take a bank down or can lead to the next giant great recession like we had with the real estate debacle back in 07, 08, where people were significantly underwater on their houses. Well, the one we're looking at is where people are significantly upside down on their cars. And if the banks have to continually repo cars because people are saying it's not even worth keeping, or their income's dropping, and they let these car payments go and they let them go back to repo, then these banks have to auction these cars off, and they have to take the negative costs, the negative equity and the costs on that loan, and the cost to repo it, even if it's a voluntary repo, and then come after the buyer, come after the customer for that negative equity. Well, and that balance, and generally there's tons of fees, repo fees, all that stuff, collection fees, accumulated interest and penalties, and all this is piled. It's like dealing with the IRS. It's piled on there, and they have to chase that person down for the money. Well, if that person let their car go, that was how they got around in the world, they probably don't have the money to pay that deficiency. So now they've got a bill going out and a collection company probably hired to chase that money down, and it's just gone. At that point, they say it's a write-off, right? Well, they're going to have to write it off as a loss, but that's real cash money they put out to the car. They collected only so much interest, and a lot of these defaults, the challenges is that they didn't have these loans for 3, 4, 5 years where they collected so much interest, and now the car is going back and they made enough money on them. These are car loans that got done within the last year. So many of them in the last year and a half, while prices were to the moon, and now the cars are nowhere near that. The people can't get out from underneath them, and the interest rates were not favorable, so these people just let them go. And now the bank's going to have to take that hit. So what are the banks doing? The banks are requiring higher down payments, even for people with good credit. So my recommendation is, I'm going to say this till I'm blue in the face. I've said this so many times, people still message me and ask me what to do, is do not walk into a dealership without your own financing arranged. There's so many ways. You can go to Capital One yourself. You can go to a lot of these banks yourself, and you can Google, low interest car loans, best car loans. You can go to USAA. You can go to Navy Federal Credit Union. You can go to your own credit union, Schools First Credit Union. Find a credit union and go and deposit $100 in the account and open a bank account there and apply for the loan. I literally did that. That's how I ended up with Navy Federal. When I bought my first Lamborghini, they said, look, it's Friday, it's 3 o'clock. You need $80,000 plus your $20,000 down payment, like before 5 o'clock, or the car is going to be sold to somebody else. And I was like, yeah, it probably will. I mean, it's a pretty amazing car. He said, there's a Navy Fed right around the corner. I went down there, walked in, deposited $100 into that account. Heck, the money's probably still sitting there. $100 into that account because I didn't bank with them. And instantly, I was able to apply for the loan. Instantly, I got approved for the loan. And then they were able to cut that check, hand me the check. And then I decided on my way to the dealership to go ahead and go through Premier Financial Services, as the amazing Juan called me back and said, dude, you're approved here, and we have a relationship with them. We'll fund the loan on Monday. They'll let you roll in the car today. I was like, man, what a bunch of drama that was. But it was awesome because I got an interest rate that I was comfortable with at the time. And at the very least, if you know what the credit union is going to give you, meaning there is no buy rate and sell rate, there's not a rate that is being margined by the dealership. You know, if they give you 6.9% interest, then nobody's making money on top of that. So you're getting a pure interest rate. But if you go to the Dodge dealer, for example, and they run you and they shotgun you and they come back and tell you, well, it's going to be 9.7%, it's going to be 8.9%. Just know there's a good chance at your credit union you were going to get 1% to 2% lower on those cars. And next, on used cars, just know that with the values dropping so much on both new and used, The rate already is generally going to be about 1% higher on used cars than it is for new cars, and the term's always going to be a little bit lower because they know that car is already starting to hit deep depreciation, and they don't want to catch a falling knife. So on a new car, they'll go longer because they know that the warranty's in place. Then on a used car, they'll do shorter loan periods because they don't want to get stuck with a car that's outside of warranty if you were to repo, or have a massive repair that ends up taking you out of being able to make those car payments. Because if you're choosing between fixing the car or making your payments, you're screwed. If you fix the car, you can't make the payment. If you make the payment, you can't fix the car. So they want you to have a warranty. So that's why they charge more on used cars. At least that's what I've been told and what I've experienced with banks over the years of buying over 50 cars. So the point of this video is to say, be prepared for it to be harder to get those zero down loans. Be prepared to, especially when you pay MSRP, because remember, the banks are simply pulling out their old playbooks, and they're looking at the old playbooks and saying nobody ever paid MSRP in the past, so MSRP is more than the car is really worth in real life. They're also looking at used car values, meaning used cars, the second they roll off a dealership floor, what are they worth at that point? And if the depreciation is, they used to say, well, you're going to lose 10% just driving off the dealership floor. But if right now, based on MSRP, it's actually a 20% hit, that's why the banks are saying you need to put more money down, even though you got great credit. And I do believe to an extent that some cars are going to be rated differently than others, which means potentially could some of these Stellantis and Dodge products be hit a little bit harder with depreciation concerns by the banks and them ask for more money down? Well, potentially. But here's my recommendation also. Walk in with your own financing and fight like hell to pay under MSRP to close that gap, make the bank feel more comfortable. One last thing, just because Navy Federal tells you, or USAA or your credit union tells you you're approved for, let's say, $50,000, even if they give you a check that all you need to do is put the VIN number of the car and they can call the 800 number and fund that thing, just know when they call that 800 number on that check, when they call to get that loan funded, there's a chance that the bank doesn't agree with what the car is being sold to you for. And that is what you're going to start seeing happening more and more now. So you're feeling good, you've got 50 grand, you're solid. They're still going to look at the ratio of the price that you're getting that car for and what they think that car is worth and the risk involved with it, even if you've got great credit, which means they're likely to come back and say, no, we won't loan that much, in which case you have to put more money down or negotiate that price down, which is why now more than ever you're going to have to negotiate harder to get those prices down to mitigate the amount of down payment, because a lot of these car dealerships will tell you that the bank wants more of a down payment because of you, because your credit's not perfect, because you were late on something 5 years ago and you have an 800 FICO score, but that one thing is still lingering there. You had a bankruptcy 7 years ago that's still sitting on your credit, so for that reason they want more money down. Just know there's about I would say a 90% chance, maybe 70% chance in some circumstances, where the reason why they want the money has nothing to do with you, has almost nothing to do with you. It's maybe a little bit to do with you, but more so because they know that that car is going to depreciate in value, the payments are going to be really high, and that the chances of you saying, wow, I'm not keeping this thing, if you're $10,000 upside down and things go sideways, that they end up back with that car, they're not going to get caught with a $10,000, $20,000 hole that they've got to fill and chase you for, because you're likely not going to pay it. So that is the concern you should have, everybody should have. Walk into the car dealerships now. You have to get the cars for under MSRP. The banks aren't going to want to participate in the MSRP. I'm going to bet you anything. But Brad, I just bought a car, zero money down, 800 FICO score, and I got 6.9%, or I got 2.9 introductory rate from Mazda or something like that. Good for you. Believe me, there's exceptions to everything. I'm talking about the average Joe out there, like all of us, that's walking into a dealership. You got to walk in with your own financing, otherwise you will not know. You will not know how bad you're getting hosed on that interest rate. And when they tell you need more down payment because of you, it's likely because the bank does not believe that that car has any ability to hold its value. And they certainly aren't going to participate in markups. So with that, everybody, hopefully this helps you. Please like, subscribe, comment, share this to anybody out there shopping for a car so they can avoid getting nailed by these dealerships. And I'll see you in the next one. Bye-bye.